Kelly, great to be here. Actually, it's an interesting dichotomy that we're seeing. On the streets of our markets, we're seeing strength, right? Jobs are incredibly strong. Unemployment is low. You have a great amount of equity in homes. I think a report on CNBC this morning said there's $6 trillion in equity available to consumers today. So we're seeing strength with the consumer, but yet you have this flashing red light of the bond market. Right now, I think the 30-year bond is at, 1.9%, a historic low in terms of yield.
Right. And people, you can tell us, they say that's, terrible formula for banks. I noticed also, by the way, an increase in HELOCs. We were talking about those the other day, home equity lines of credit. Why do you think people are taking those out?
I think people are taking advantage. The equity is back in the homes, and everybody is fearful, right? What is the bond market telling us? And I guess my biggest concern is that it becomes a self-fulfilling prophecy, that we're so worried about a recession that we talk ourselves into a recession. We're not seeing a recession on the streets today.
Brent, I'm curious. There are a lot of people out there who are watching that 10-year yield fall, and right now we're at about 1.46%. Is there a line in the sand at which mortgage rates for the consumer won't go much lower?
A great question. And I think we may have seen that, right? The spreads in mortgages are widening out. So as the 10-year goes down, I think this morning we saw that the average mortgage last week was about 3.96%. So that spread is widening. And I don't think people have a lot of appetite to portfolio 30-year mortgages at a rate substantially below 4%, quite truthfully.
So if you're waiting for mortgage rates to drop more, don't wait, is what you're saying. They're not going to drop much further.
I think there's a lot of truth to that, and I think there's a lot of refi fatigue out there. I don't think consumers really care about an extra quarter point. It just doesn't make that much of a difference to them.
Brent, tell us about what low interest rates mean for your earnings power.
The good news for us is we've transitioned from a mortgage-dominated shop to a commercial bank. So low interest rates are actually opportunities for our commercial borrowers to lock in lower rates. Unfortunately, it's more pain for the depositor. You'll continue to see lower rates for the depositor.
Right.
But we have several levers we can pull.
So for you, though, I mean, are your short-term funding costs coming up relative to what you're able to make on some of those longer-term loans?
Short-term funding costs were going up with the Fed moving up, but we anticipate that there will be some delay, some lag, but we anticipate those will start going down thanks to the Fed moving and the decrease in interest rates.
Last quick question, Brent. You're talking about how strong the consumer seems when you take a look at what's going on Main Street. At the same time, there's all this talk about a flashing warning sign of a recession. Are you concerned at all about this notion of talking ourselves into a recession at this point?
Very much so. I think it's caused everyone to take pause. When someone's about to make a major purchase, they're asking themselves, am I doing it at exactly the wrong time because what the bond market is showing? That there's real reason that we could talk ourselves into a recession. But the other thing I would point out, too, is not all recessions are equal. And we tend to have recency bias. We think of what the last recession was, which was a Great Recession, which, of course, was the biggest financial turmoil we've seen since the Great Depression. And in all likelihood, the next recession will be just that, a dip, and maybe not as bad as what we saw last time.
All right.